Welcome back to the deep dive. Today, we're on a pretty critical mission, I think. We are trying to synthesize the single most reliable blueprint for building, significant long-term wealth.
hmm
And our sources here, they aren't from social media gurus promising you'll get rich overnight. These are time-tested, proven strategies.
That's the key, right? The difference between certainty and just pure speculation. What we've pulled together, it all points to three core ingredients. They're just not negotiable.
Okay.
First, you need consistency in what you put in. Second, you need the patience to just ride out the market's ups and downs.
Right.
And third, you have to trust the math. You have to let compound interest do all the heavy lifting for you.
And the reason we can talk about this with some level of certainty is, well, it's history. The engine we're using here, the broad U.S. stock market, so things like the S&P 500, historically, its baseline performance is about a 10% average annual return.
Right, and that's with dividends reinvested, which is a key point.
That 10% is the anchor for this whole plan.
Exactly. And, we should acknowledge recent performance. In 2025, the S&P 500 was up, 17, 18%, which is huge.
Right year.
A fantastic year. But you can't get distracted by that. The disclaimer is always, always true. Past results don't guarantee future gains. But the method we're talking about, the strategy of just capturing that long-term average, it works whether the market's up 18% or 5% next year.
It's the consistency that smooths out all that noise. Okay, so let's unpack this blueprint step by step. Before we even talk about where to put your money to grow it, we have to talk about defense.
Yes.
You just can't build wealth if your foundation is, shaky.
That is the first critical layer. You have to secure the base. And priority number one has to be debt, specifically high interest, what I would call toxic debt.
Okay, so what's the cutoff?
The sources are really clear on this.
Yeah.
Anything costing you more than 10% interest.
And that 10% number is so important because it ties directly back to what you just said about the market.
Exactly. If the market gives you an average of 10%, but your credit card is charging you, say, 15, 20%.
You're losing money on every dollar you invest. You're netting negative.
You are fighting an uphill battle against a guaranteed loss. I mean, think about it. Paying down a credit card that costs 20% is an immediate, guaranteed, tax-free 20% return on your money.
Wow.
No investment on earth can promise you that. So you have to kill those high-interest liabilities first.
I want to push back on that just a little. Let's say I have a student loan at 12%, and I'm young. Shouldn't I invest maybe $50 a month just to build the habit of investing, even while I'm hammering that debt?
That's a really important nuance and a great question. Mathematically, no, you should put every single spare dollar toward that 12% loan.
Right.
But behaviorally, yes. Starting the habit is incredibly powerful. So the compromise that a lot of successful investors use is this. Invest just enough to get your full employer 401k match. We'll talk about why that's free money in a bit. And then every other dollar you have goes to killing that debt above 10% until it is gone.
That makes a ton of sense. Okay, so once that toxic debt is gone, what's the next defensive step, a safety net?
This is non-negotiable. An emergency fund. It needs to cover 3 to 6 months of all your living expenses. This is the insurance policy that protects your investments.
So if you lose your job, you're not forced to sell your stocks when the market's down.
Precisely. You don't lock in losses, you pull from your cash, but where you keep that cash is also crucial.
It can't just sit in a checking account doing nothing.
Right. It needs to be liquid, but also productive. That means a high-yield savings account. And for you, the listener, it's worth noting this has changed so much recently. As of January 2026, some of these accounts are offering up to 5% APY.
5% on risk-free cash you can get tomorrow. That's a massive tailwind.
It's something we haven't seen in years. It makes holding that emergency fund, actually financially viable, not just the drag on your returns.
So debt is managed. The safety net is in place. The third piece of the foundation is it's all psychological. It's the mindset.
It's the fuel for the whole engine.
Yeah.
You have to live below your means. It's that simple. And the data on millionaires is incredibly clear on this. The vast majority save 15 to 20% or even more of their gross income.
So without that savings rate, none of the other stuff really works fast enough.
Exactly. You can't invest money you don't save.
Okay, defense is set. We're secure. Now we get to shift to offense. And the turbocharger for this entire plan, compound interest.
What's truly fascinating here is how often this gets misunderstood. People think it's just simple growth. It's not. It's exponential growth. It's the mechanism where the money your investments earn
Mm.
starts to earn its own money.
Money making babies.
That's a great way to put it. And then those babies make babies. That acceleration is what turns small, consistent contributions into, massive wealth over decades.
And this is where it gets really interesting because time becomes the most valuable asset you have. More than money, more than anything. The math of starting early is just staggering.
Let's use that concrete example from the source material. It just makes it so clear. Imagine you're 25. You decide to invest just $500 a month, every single month.
Okay.
And let's say you get a slightly more conservative 8% average annual return. After 40 years, that account will grow to over $1 million.
$1 million. But let's break that down. How much of that did the investor actually put in versus how much did the market just create for them?
That is the punchline. Over 40 years, at $500 a month, you contributed a total of $240,000 of your own money.
Okay, $240,000.
The other $760,000, three-quarters of the entire amount, is pure growth from compounding. Your money did 25% of the work. The market did 75%.
That's incredible. And it shows you can't make up for those lost early years. The compounding just doesn't have time to work its magic later on.
You can't, which makes the priority crystal clear.
Okay, so that leads to the biggest question. If the goal is this reliable long-term growth, what do you actually buy? Where do you put the money?
Right. We need the vehicle to capture this, and it needs to be the most boring, reliable, and cheap choice possible. We are not looking for excitement here.
And the sources were, incredibly unified on this point.
Universally, the go-to strategy is low-cost index funds, or ETFs, exchange-traded funds. Specifically, funds that just track the broad market, like the S&P 500.
We mentioned some examples like VOO or VFIAX. For someone new to this, what are they actually buying with one of those, and why is that low-cost part so critical?
You're buying a tiny slice of ownership in the 500 largest public companies in the U.S. It's instant, massive diversification. But the low-cost part is mathematically vital. These funds are passive. There's no expensive manager trying to pick winning stocks. That lets them have incredibly low fees, what we call expense ratios, often less than 0.1%.
So for every $100 I invest, they take 10 cents a year.
Precisely. And that tiny difference, say between a fund that charges 0.5% and one that charges almost nothing, that compounds against you. Over 40 years, that small fee difference can cost you tens, even hundreds of thousands of dollars that could have been in your pocket, compounding for you.
It's so simple, but so powerful. It's why one of the world's greatest investors, Warren Buffett, says this is the way to go for almost everyone.
It is. His advice, and it's quoted everywhere, is to consistently buy an S&P 500 low-cost index fund. If the guy whose whole job is picking stocks tells everyone else to just buy the whole haystack, that's the strongest testimony you can get.
Just buy the whole market and go on with your life. And the principle here is diversification. Don't put all your eggs in one basket.
Right, that's the next piece. The index fund diversifies you across U.S. stocks, but you also need to think about broader asset diversification. So spreading risk across stocks for growth and bonds for stability.
So how do you figure out that split, the allocation between stocks and bonds?
It really depends on your age and your risk tolerance. Your timeline is everything. If you are decades from retirement, you can ride out any downturn. So younger investors typically start with a portfolio that's heavily weighted to stocks, maybe 80 or 90% stocks, and only 10 to 20% in bonds. You want maximum growth. You have 30 years to recover from any crash.
But as you get older,
say in your 50s, you start to gradually shift that balance. You might move toward a 60% stock, 40% bond split. Bonds tend to hold their value or even go up when stocks go down, so they stabilize your portfolio when you're closer to needing the money.
Okay, so we have the foundation, the engine is compounding, the vehicle is index funds. Now we need the action plan, the strategy, because just picking the investment is only half the battle.
Absolutely. The first strategy is really just psychological management disguised as math. It's called dollar cost averaging, or DCA.
And that just means investing a fixed amount on a regular schedule no matter what.
Exactly. Every 2 weeks, every month, the same amount goes in, whether the market is at an all-time high or in a total free fall.
And the beauty of that is it takes emotion completely out of the equation, which is the #1 enemy of the long-term investor.
That is spot on. It's a psychological guardrail. It stops you from making two huge mistakes: dumping all your money in at the top when you feel euphoric, And more importantly, it forces you to keep buying when you're panicked and prices are low.
So when the market drops 20%, my DCA plan just sees that as a 20% off sale.
Precisely. You automate the behavior of buying low. And right alongside that, strategy number 2 is maximizing every tax advantage the government gives you.
Which brings us back to the 401k match. We called it free money, but let's really break down why it's just mathematically mandatory.
Because it is the only time in your life you will get an instant, guaranteed return that just crushes the market average. If your company offers a 50% match, that means for every dollar you put in, they put in 50 cents. That is an immediate, guaranteed 50% return on your money.
50%. Not a chance at 10%, but a guarantee of 50. You just can't walk away from that.
Leaving that on the table is one of the biggest financial mistakes anyone can make. You always contribute enough to get the full match first. Then you look at IRAs, and only then do you move to a regular taxable brokerage account.
Okay, we've covered the mechanics. Now for the hardest part. The mindset. What do you do when the news is screaming about a recession?
You ignore it. You ignore the short-term volatility. The single biggest predictor of success with this plan is the ability to just stay invested. Every major market downturn in history has recovered and hit new highs. Panicking and selling just locks in your losses.
Which leads right into the pitfalls. If we're long-term investors, we have to stop acting like day traders.
You have to. Don't chase hot trends. Don't try to time the market based on a headline. Unless you have a small amount of what you call play money that you are fully prepared to lose, your core wealth-building money needs to stay boring and broad. The goal is reliability, not excitement.
One last operational detail. We talked about low fees. What about dividends? The money the fund pays out, what do we do with that?
Always reinvest them. When you get a dividend payment, you set it to automatically buy more shares of the fund. That is a critical part of the compounding machine. Those new shares will then generate their own dividends. It accelerates the whole curve.
Okay, let's put it all together. The path seems to be built on 4 pillars, in order. First, the foundation, kill high-cost debt, build the emergency fund. Second, the engine, which is compound interest fueled by time. Third, the vehicle, simple, low-cost, broad index funds. And fourth, the driver, which is your strategy of dollar-cost averaging and pure patience.
That's it. Consistency over decades, that's what separates people. It's not about finding the next big thing. It's about owning a piece of everything and just letting the global economy do its work.
And to bring the timeline back into perspective, if you commit to investing just $200 to $500 a month wisely, you are on a very realistic path to becoming a millionaire by retirement. The market provides that baseline.
It all comes back to that wisdom from Buffett. Invest in what you understand, be patient, and let compounding do the work. The beauty is that here in 2026, the strategy is still so beautifully simple.
The path is clear. The single most powerful thing you can do right now is just to start. Open the account. Make the first purchase of a broad index fund. Don't wait for the perfect moment. Just start today.
And here's the final thought to leave you with. That $500 a month example gets you to $1 million in 40 years. But most people's income doesn't stay flat for 40 years.
Right. You get raises, you change jobs.
So what if you commit to increasing that $500 contribution by just a small amount, say 3% or 5%, every single year as your income grows? How dramatically does that multiplier affect that combination of more money going in and compounding returns? How much does that shrink the timeline to get to $1 million? That commitment is the next level of accelerating your wealth.